There's this wonderful idea from the late Charlie Munger. It's basically like a cheat code for finding really outstanding ideas. Just look closely at what other really smart people are buying. Simple, right? And the amazing thing now with the way things are is that this info isn't hidden away anymore, not like it used to be. Thanks to SEC disclosures, those quarterly 13F filings, we can actually get a pretty good peek into what the top fund managers are doing. Holding, trimming, adding, it's all there. So today we're going to follow the money trail left by someone who's definitely certified smart, especially in tech, Philippe Lafont of Coatue Management. And look, we pay attention because, well, he earns it. His fund's public equity portfolio, it just crushed the market, outperformed the S&P 500 by about 95 percentage points. That's over the 3 years ending in June. So, yeah, when Lafont makes a big move, you kind of have to ask, why?
Absolutely. And that leads us straight to their latest 13F filing. And this isn't just, minor tweaks around the edges. It really looks like a huge pivot right in the white-hot center of the tech world right now, AI semiconductors. So the mission for this deep dive, let's try to unpack the thinking behind this pretty radical strategic shift they're making. Coatue is actively trimming its stakes in the massive GPU companies, the ones that really powered that first big wave of the generative AI boom. But crucially, they aren't getting out of tech altogether.
Yeah.
Now they're shifting that capital, that huge bet, onto a fundamentally different kind of chip company, one focused entirely on core architecture.
It's a really fascinating move, a big reallocation. Okay, so let's dig into the exits first, because the scale of these sales is, well, it's pretty eye-popping. We kind of have to start with Advanced Micro Devices, AMD. You have to remember the context here. Not that long ago, especially when generative AI really started exploding, late 2022, early 2023, AMD was seen as a serious challenger to NVIDIA. It actually became Coatue's third largest public stock position. That was a massive vote of confidence, right, in their ability to compete in AI hardware.
Oh, it was a huge holding. And they were perfectly placed, you'd think, to ride that whole wave of demand for AI infrastructure. But this latest filing, it shows a pretty shocking reversal of that confidence. It really suggests Lafont sees the trajectory for these specific hardware companies very differently now.
The numbers are just, frankly, they're staggering. Since that peak holding in mid-2023, Lafont has sold off, get this, 89% of his entire AMD position. And just in the last reported quarter, he cut what was left by another 53%. I mean, that's not just hedging. That's a very deliberate, very aggressive exit.
Yeah, absolutely. And it wasn't just AMD either. You see this broader skepticism about the main GPU players. Coatue also slashed its stake in the market leader, NVIDIA, by around 77% since early 2023. Although it's worth noting, they did add back some NVIDIA shares last quarter, maybe a little hedge. But the really aggressive selling was focused on AMD. That just kept going.
Okay, but here's where I gotta push back a bit on the genius's timing thing, because the timing of this huge AMD sale, it wasn't exactly perfect, was it? I mean, since the end of June, AMD shares have actually outperformed NVIDIA recently. So if he's such a master timer, why get out right when AMD seems to be, getting its act together?
That's a really crucial point, and it kind of highlights the difference between maybe short-term trading calls and long-term thesis investing. So, yeah, maybe his timing missed that recent little rally in AMD, but what fueled that rally was external news that, if anything, just reinforced AMD's direct competition with NVIDIA in the current hardware race.
You're talking about that huge OpenAI deal.
It's exactly that AMD announcement. It's potentially game-changing, right? OpenAI is lined up to buy maybe up to 6 gigawatts worth of AMD GPUs over multiple years, and maybe even more telling. OpenAI gets warrants to buy AMD stock for each gigawatt they take. I mean, that's about as big a vote of confidence as you can get from, the most important AI company out there.
So, okay, on one side, you have this massive signal. OpenAI basically saying, yeah, we believe AMD can compete head-to-head with NVIDIA. And that belief is tied specifically to AMD's next big thing, the MI450 GPU platform, which, AMD management is claiming will beat NVIDIA's upcoming Rubin platform in both training and inference. But then on the other side, you've got Lafont basically saying, great news for you guys, but I'm heading for the exit. Why? Why would a manager with his track record just walk away from what looks like potential multi-year upside right as the company seems to lock in its competitive footing?
Well, it strongly suggests he's looking past the next quarter, or even the next year's chip performance battles. He seems to be betting that the core issue isn't really about who has the absolute fastest chip in, say, 2025. It's more about the fundamental, maybe structural limits that the entire AI scaling process is going to run into by, 2030.
Yeah.
The thesis seems to be that the current hardware leaders, the ones relying on just brute force speed, are essentially heading towards an inevitable infrastructure wall. like a Powerwall.
That makes a lot of sense, actually. So he's not betting on who wins the current race. He's betting on the limitations of the racetrack itself. And that pivot, that brings us finally to the heart of their new, really big investment. Okay, let's shift focus. Coatue biggest buy last quarter, a totally new position in ARM Holdings, ARM. And this is where that architectural bet really comes in, replacing the hardware bet. For listeners who maybe don't follow this deep infrastructure stuff super closely, can you just quickly explain the difference? ARM doesn't actually make and sell chips like AMD or NVIDIA does, right?
Yeah, that's exactly right. ARM is purely an intellectual property company, an IP licensor. They provide the basic chip architecture, think of it like the fundamental blueprint, and then other chip designers license that blueprint. Companies like Apple, Qualcomm, even NVIDIA for some things. They license ARM's IP and then build their own custom chips on top of it. So yeah, ARM sells the recipe, not the finished cake.
And what's so interesting here is ARM's history, right? They really made their name, became dominant even in the smartphone market. And in smartphones, energy efficiency wasn't just nice to have, it was absolutely critical. You couldn't have a phone that, got burning hot or died after 3 hours.
Exactly. And that history, that DNA focused on low power, is now suddenly their biggest advantage in the data center. And the reason is pretty simple. Energy efficiency is fast becoming the main limiting factor for scaling compute power at data centers. It's not just about raw chip speed anymore. It's about whether you can physically power and cool tens of thousands, hundreds of thousands of these incredibly power-hungry chips all packed together. It's like needing to rebuild the entire electrical grid just to handle bigger, faster car engines. The infrastructure, the power, the cooling, it just can't keep up indefinitely with the demands of these super fast GPUs. So that energy supply, that's the emerging bottleneck. And ARM's architecture, because it's inherently more power efficient, is really well positioned to kind of sidestep that specific limitation.
Okay, so let's unpack the potential payoff Lafon is seeing here, because this is why they're taking such a huge, high-stakes position. This isn't just a bet that ARM will grow a bit. This is a massive long-term prediction about, market dominance, right?
Oh, it's a phenomenal forecast. I mean, Lafon is on record saying he sees ARM Holdings market cap climbing to, wait for it, $787 billion by 2030.
Wow. Just wow.
Yeah. So ARM's current market cap is roughly $179 billion. We're talking about a potential 340% increase in just about 5 years. That's not just growth. That's pricing in some serious foundational disruption. They're essentially betting the entire data center infrastructure tilts heavily towards energy efficient design, and ARM is the key enabler.
Okay, so if that's the prediction, the audacious call, what actual proof do we have right now that ARM is really making headway, that they're succeeding in this pivot into the really valuable data center market? They need more than just a nice story.
No, they have some pretty concrete adoption numbers. We're seeing 70,000 enterprises are now actively using data center chips that are based on ARM's IP. And what's really incredible about that number is it represents something like a 14-fold increase in just 3 years since 2021. So the adoption curve looks, well, pretty exponential right now. It suggests their architecture is genuinely making deep inroads into server racks. And if you want, the perfect example of how they're penetrating the market, just look at their biggest competitor, or maybe frenemy, NVIDIA itself. NVIDIA built its Grace CPU. That's a specialized processor they use in their huge Hopper and Blackwell server systems. They built that using ARM's foundational IP. So the biggest GPU maker is actually relying on ARM for its crucial CPU component.
Right. And beyond just adoption, the source material we looked at mentioned ARM is also getting better pricing power for its latest designs, specifically that new V9 architecture. So they're not just selling more blueprints, they're charging more, a premium for the latest and greatest blueprints.
Yeah, and that pricing leverage is absolutely crucial if you're trying to justify the kind of valuation ARM has. And we see this command of price showing up directly in their financials. Royalty revenue, which is, their core recurring income stream, was up a healthy 25% year over year in the first quarter. And importantly, that growth was specifically driven by higher royalty rates that come with customers adopting the newer, more valuable V9 architecture.
Okay, so the thesis is knitting together. Companies adopt V9, they pay ARM more for it, that drives revenue growth, and eventually maybe that growth justifies the current stock price. But this brings us right to the massive caveat, the elephant in the room that even the biggest bull has to acknowledge. You mentioned valuation, and I have to stop you there, because when you look at ARM right now, the stock trades for nearly 100 times forward earnings estimates. Yeah. 100 times. Isn't that a classic bubble sign? Chasing hype. Regardless of how good the long-term story might sound, isn't this exactly the kind of super risky speculative valuation that, smart money is supposed to avoid?
Look, that raises a really important question. It's about risk tolerance, right? And how you
Right.
value potentially disruptive tech. And yes, you're right. By any traditional metric, 100 times forward earnings is terrifyingly expensive. It is a very tough multiple to justify, especially since we're talking about estimated future earnings, not cash already in the bank. It definitely makes the stock look on the surface very risky, no doubt about it. But this is precisely where LaFont's conviction comes in. His thesis is essentially differentiating ARM. He's betting ARM isn't just another tech company. If that adoption curve for V9 continues, and if that shift towards energy efficiency in data centers becomes as critical as he thinks, then maybe the total addressable market is being dramatically underestimated right now. So LaFont is basically arguing the growth rate will be so extreme because data centers will almost be forced to adopt energy-efficient architectures just to keep scaling, that today's 100x multiple will actually look reasonable or even cheap in hindsight. It'll normalize quickly because the earnings will explode upwards.
Right. So he's not arguing the valuation is cheap today. He's arguing the future growth is so massive that the denominator in that PE ratio, the earnings, will eventually catch up and maybe even surpass the current price expectation. It's a conviction bet. Pure and simple. You either believe the market is massively underestimating how severe this data center energy problem is going to be, or you think the current stock price is way, way ahead of reality.
Exactly. It forces you as an investor to really take a stance on the fundamental direction of AI infrastructure. Is the future just about faster and faster processing? Or is it about smarter, more sustainable, more efficient architecture? LaFont's huge capital move clearly shows which side of that debate his fund is on.
Okay, so let's just quickly recap the narrative we've pieced together here from the data. We've seen a top-tier manager, Philippe Lafont, make a really dramatic strategic shift. He's largely exited the high-flying, brute force GPU makers, even AMD, right, as it got that huge confidence boost from OpenAI. And he's taken that capital and made a massive, arguably very risky, but clearly foundational bet on ARM Holdings, betting on the underlying energy-efficient architecture provider.
So what does this all mean for you, the listener, trying to track this incredibly fast-moving AI race?
Well, it suggests we might be witnessing a potential shift, maybe moving from that initial sort of brute force phase of AI defined by who simply has the fastest chip towards maybe a more mature phase. One focused on foundational sustainability, on efficiency. Lafont is making a fundamental bet that it's the scaling limits of energy supply in data centers, not just raw clock speed, that will ultimately determine the next set of market winners. It's a bet on infrastructure physics more than just processing power. That's a really profound thought. A potential realignment of what matters most. Okay, so for our final provocative thought for you to chew on, considering ARM's almost unbelievable valuation right now versus its massive disruptive potential, how do you, as an investor or just an observer, balance that? Balance the proven performance and market dominance of today's leaders like NVIDIA and AMD against the potentially explosive but definitely high-risk growth story of a foundational technology like ARM, and maybe take it a step further. If the big constraint today is energy efficiency and power delivery, what's next? What other architectural or foundational component might become the next core limiting factor as the AI boom tries to keep expanding exponentially? Maybe cooling tech, interconnects, networking, something else entirely. Definitely something to think about as you look for the next deep dive into the infrastructure wars.